But the only thing that you need in real estate is whether you're investing as a passive investor or you're doing it yourself, you gotta be patient and consistent. Those are the two key things that you need for that. And we learned about the syndications and the private placements. We started investing passively. And it was stress-free investing for us because no tenants, no toilets, no termites. And we were enjoying that status. But very quickly, I got a chance to be on the active side.
Welcome to Investing for Generational Wealth. I'm John Clive from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. And together with investors, we're investing in over 1,000 multifamily apartments under renovations and over 500 single-family rental homes under development. And we're expanding into private debt, industrial commercial real estate, oil and gas ventures, and much more to create a diversified, balanced portfolio. Before we begin, a quick disclaimer, just like always, we're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA and your attorney before beginning investments. I'm your host today, John Lai, and welcome to today's episode, Creating Passive Income and Long-Term Wealth Through Real Estate Investing with Vinki Loomba. Now, Vinki is the CEO of Loomba Investment Group and fund manager of Loomba Capital Partners, and she shares strategies for creating passive income and building long-term wealth through real estate investing. She has a wealth of experience, tons of asset classes. So let's dive in. Vinki, for those who don't know your story, do you want to talk about how you got to where you are today?
Definitely. Thank you so much, John, first of all, for inviting me to your portal. What a great opportunity to share my journey. So today I'm here. I'm not going to be talking mainly about, how to do this and that. I'm just going to share my journey from tech world to real estate, how I got financially free, because I love to share that. And then see if that resonates with somebody. They can pick the tidbits here, there, and they can create their own kind of, train to walk on and get there wherever they wanted to go. Because I understand from my experience, the best way to learn is from others' experience. So I love to share my experience. I told you, I'm a former professor. So I love to teach, but in a different way.
There you go.
Okay. That's much better. So thank you again for inviting me. And today our topic is generate passive income and lasting wealth without trading your time. I think that's the most important thing, because everybody is trading their time for money, because we think like, oh, if I do this, if I do that, I'll make more money. But one thing first, a small little disclaimer before we get started. This session is strictly for knowledge sharing purposes and should not be considered a legal, accounting, or investment advice. And this section does not represent an offer to sell or a solicitation an offer to purchase an investment. So if you have any legal questions, please reach out to your financial advisor, your attorneys. Like John said, we are not the financial advisors. So please reach out to the appropriate people. This is just for educational purposes only. So I wanted to start with my favorite slide, the quest for freedom, before I give introduction on myself, how I got started. Because, we have the same quest, everybody, So if you take a minute and look at this picture, the image, you can see that there's like a wide road of possibility. That's what I look at it. And then, there's endless possibilities, so endless ways for us to create the freedom. And then freedom means something different for everybody. It's not necessarily, let me move you to this side. I think I'm looking on my other screen when I'm looking at you. So when I say freedom, it's not just like freedom, you take a vacation or you just quit your 9-to-5 job. Freedom has a different meaning to everybody. It's like you choose things, whatever you wanted to do freely. That's the true freedom. And I think I love this quote. I just say this all the time. So I made my quote now, that freedom is not the absence of commitments, but the ability to choose and invest in what truly matters, So your freedom is maybe just spending time with your kids and you don't want it to get disturbed, or you want it to go spend time with your husband, wife, or your parents, maybe that's the freedom for you. So that's the reason it's relative and it's not like just like making money is the freedom because that's not the true freedom. So as we go through this presentation, I would like you to reflect on that what freedom truly means to you. Because once you create that in your mind and have that sense of freedom, what freedom means to you, you're going to create some space in your mind. When you have some space and not that much chaos in your mind, you know what happens? Creativity happens. You're going to figure things out for yourself. Okay. So you asked me about myself. So a little bit about myself before we dig deep. My name is Vinki Loomba. I don't know how many of you already know me. If you do not know me, I'm the founder of Loomba Investment Group. I'm also a fund manager for the Loomba Capital Partners. I do have a popular podcast, the Real Estate Vibe Show. I'm a former IT professional and a professor. I was in IT for 20 plus years. And at the same time, I taught at California State University for about 10, 12 years, the executive MBA program on an IT domain because I was the IT professional, didn't know anything other than IT. I'm a mom, I'm a wife, and I'm really, really passionate about my nonprofit. My nonprofit is towards women and children. And that's my mission. That's my being. That's the reason I'm here. And that's the reason I do what I do. And I think when you're doing things for others, you get more joy, you get more freedom, and you get more success. That's the way I look at it. Beside work, I like to travel. I like to experience diverse cultures. I love cooking. Cooking's like a meditation for me, creating something from scratch. I love to hike and I love nature. I like to spend time in nature and kind of connect with myself when I go out. So, um, this is what I'm going to be talking about today. Why I chose real estate for passive income. I'm going to talk about my real life success story, how it became success from day one. We're going to talk about protecting your investments, talk about building wealth and generational legacy. My outlook in 2025, what I'm thinking right now, because a lot of people are scared. They're just like, don't do this, don't do that kind of thing. So I'm going to show you my perspective, how I'm looking at things. And last but not the least, we're going to talk about the mindset for financial success. I think is very important. Everything boils down to mindset. If you have the mindset, you can achieve anything in this lifetime. So, yeah, any questions before I get started?
No, I think this is a great agenda.
Okay, perfect. So, I'm going to talk about my first slide, why real estate for financial freedom. So, like I told you, I came from a strong IT background. Just like every other Indian, I say all the time, I'm from India. Originally, I came to United States, just like every other Indian, I would say we just end up in tech world. So I end up in tech world too and started climbing the corporate ladder. And with W-2, it was not enough for me because I think we are accustomed to trade our time for money. So I was like, oh my God, I'm young, invincible, I can do anything. So beside my W-2, I started doing my MBA over here, did my MBA. As soon as I got my degree, I got position to teach as a professor. So I took that on too. And around that time, what happened, or we built our second home. So we were in a position, this is like 20 years ago, and we were in a position to rent our first home and not to sell it. So we rented our first home. So what happened when we rented our first home? Boom, the light bulb went on because somebody else was paying our mortgage. Plus, we were getting $400-500 every month positive cash flow. And me and my husband were like, oh my God, nobody taught us anything. It's like, oh my God, this is really great because we figured out how to make money. And we started multiplying that model and we bought a few more duplexes, single family homes, and we had a small little portfolio, 4 to 6 homes or duplexes. But it was a nightmare dealing with tenant toilets and termites because we were DIY, because we just working with handymans because we wanted to do it ourselves, like I said, young and invincible kind of mindset. And during that time, I thought, oh, it's so easy. Let me get my realtor license. So another trade of time for money. So I got my realtor license. So I thought on the weekends I can sell businesses because I didn't want to sell homes. So when I started businesses, the retail side, we started investing there. So we learned from this experience how to invest, whether in the single family home or in the businesses. That was the only takeaway from that. But other than that, DIY, that model was totally nightmare work for us, because we didn't want to quit our jobs. Both of us, we were working full time. And on top of that, we just always, doing this and that, this and that, this and that, because trading our time for money didn't know better than that. So fast forward, you know, because we got burned out, and my husband said, "Okay, we don't want to deal with this thing anymore. We need to get rid of this whole portfolio." So slowly, we sold everything. We made money, and then I was thinking there got to be some way to make more money. And during that time, my position moved to New York, where I was working with my company, and they told me to move. I didn't want to move, so I took the package. So now I had the free time. So I'm like, okay, so this is the perfect time to look for something else. Maybe I should start doing merger and acquisitions because I went through so many mergers with my company. I understand the system side merger. So business side should not be that hard for me, right? I can take that on. But before I get started there, I ran into somebody's profile on LinkedIn that 400 million asset under management. I'm like, how did that happen? Because I knew this person before. So I read something, multifamily syndications. Boom, another light bulb. That's how it started in multifamily. So we started investing as a passive investor. And the manifest we saw, and that was the key thing for us, why real estate for financial freedom, because we learned that we can make our money work for us. There was a stable passive cash flow that we're getting from the rental income. And we were buying something that was tangible, that I can touch and feel and visit anytime versus the stock market. That's what we learn in the corporate world. Only the stocks and bonds, because that's where your 401k goes. And by default, you learn that. And the market resilience, because real estate always goes up. If you look at the history, from my experience to the past 20, 25 years, but we can go beyond that too. Most of the millionaires, billionaires made out of real estate, or they do have a real stake in their portfolio, somewhat, or a big chunk maybe. And I was talking to one of my attorneys the other day, and she mentioned, she's like, something very interesting. She said, real estate is cyclical. And I'm like, let's think about that. Is it actually cyclical? Yes, but I think it's spiral because it's cyclical, but it never comes to the same point. It's always going up. Because look at my first house. The first house that we bought, we got it for $120,000 20 years ago or 22 years ago. And today that house is $1.2 million. So
Crazy.
you can say cyclical, but it's a spiral, right? It's going up. If I kept it for that long, 1.2 million, right? So it's like crazily you can make money. But the only thing that you need in real estate is whether you're investing as a passive investor or you're doing it yourself, you got to be patient and consistent. Those are the two key things that you need for that. And we learned about the syndications and the private placements. We started investing passively. And it was stress-free investing for us because no tenants, no toilets, no termites. And we were enjoying that status. But very quickly, I got a chance to be on the active side. So we started investing in multifamily to start with, like you were talking earlier before, John, before we started the recording, that if I'm in multifamily, I have a divorce asset class right now, but we started with multifamily. And why we chose multifamily? Because of all these benefits that you can see here, like a steady cash flow. It was considered safe because for my thing was participating in a syndication was like, I'm working with multiple other similar mindsets who have the similar goals. So it's just like a football team, all the eyes are on the same goal. Take the deal from conception to completion. So I was not that much worried about how much I know or how much I didn't know at that time when I started, because I knew the questions that I did not know, somebody else will ask, and I'll get the answer and I'll get more insight into it. So that was my take. I jumped on it because I did not stay on the sidelines, because a lot of times people stay on the sidelines. They say, oh, I do not know enough. Maybe I should wait. maybe I should learn more before I, take action. So my thing was, I wanted to act first and learn. And then there is, multifamily I learned is more like a recession resistance because people always need a place to live. Because if the real estate goes up, the prices up for the single family homes, where people going to go? Apartments, right? And then let's say if there's inflation, it's again again inflation as well, because if there's inflation, the prices go up, rents will go up because the cost of living is going up. With that, the valuation of the property goes up. Valuation of the property goes up. You're making more money. So these were like some of the benefits I saw. That's the reason I chose multifamily. And I highlighted over here some of the active and passive investing as well over here, the difference between the two. Because when you're active, like we were talking earlier, you're doing hands-on, most of the stuff yourself. But when I started investing passively, I was creating more space in my mind, like I was talking earlier, freedom, right? So that space of freedom. And then that's where the creativity comes in because you have free time. You're not always in a chaos mode. Okay, I'm doing this, I'm doing that, I'm doing this, I'm doing that. You're always in the present mode and doing this, which is good for you. Any questions before I go on? Or you want me to go on?
No, please go on. And for those who are on the line, if you have questions, submit some. We'll answer them along the way, or we'll save them for the very end. Thanks.
Yeah, I'm just sharing my story. It's nothing technical, simply how I did it. If I can do it, anybody can do it. So some of the advantages of syndications or partnerships that I found is, first of all, it's very, very important to find the right partners who you want to work with. It's not necessarily who you like. Like is important, but you might want to dig deeper than that, just liking somebody. So I'm going to talk about that too. I think I do have a slide on due diligence as well. But some of the advantages I saw, like I mentioned earlier, it's like a football team and all the eyes are on the goal. That's how it happens in a syndication too. So with that, you have a little bit less stress because there's other people in the deal beside you who are looking at the same goal, right? And who might have the similar questions like you, or they might even have advanced questions than you that you didn't even think about. So I felt like there's a safety net right there. And then there's time efficiency because somebody else is doing the work. You're bringing the money on the table. They're doing all the work from conception to completion. So you're freeing up time. So there's a time freedom right there, right? So you can pick and choose whatever you wanted to do, whatever you like to do, spending time with your kids, with your family, vacationing, whatever, I like that. And there is some risk mitigation too, because you're not taking all the risk by putting all the $1 million or $10 million, all your money in one deal. And the risk is kind of diversified. It's across the board. How many people are in the deal? So everybody kind of sharing the load there as well. So these are some of the advantages. And also the access entry point was really easy for me because the reason it was more accessible because I remember I live in San Francisco, 20 minutes from San Francisco. So I remember when I used to go to San Francisco or even New York too, I used to see this huge apartment building. And I used to think, who owns these buildings? Who are these billionaires? How come we are not there? Or do we ever get there in this lifetime ever, like starting from W-2 to becoming a billionaire, owning this, multi-million dollar buildings? And now what I realize with syndication is possible because you're the part owner of that high rise, maybe. You own the share, you're a shareholder in that. So that is like, oh my God, it's like a total different perspective, the new way of looking at things. So these were some of the advantages for me that I wanted to do the private placements. And please let me know.
Hey, Vinki, yes. One quick question that I know investors will ask: why invest in a syndication versus a REIT or a ETF or some type of mutual fund that invests in real estate itself? Could you talk a little bit about that and why you prefer investing in syndications? Thanks.
Because syndication was, I think it's a little bit more risk than REITs, but I think it's more advantageous because in a sense, like I was looking at better returns. So I was seeing that more into the REIT and little bit more accessibility to the team. Because when you're doing the private placement memorandum, like for example, I'm going to give my example. If you choose to work with me, you're going to get the white glove service, because you can pick up the phone, call me anytime. Hey, what's going on with the deal? Where we are, what we're doing. At least you have peace of mind that somebody's there watching your back the whole time. So investing in REITs or stock market was I'm putting the money in the air and just hoping the stock to go up. And despite all the market fluctuations, I was always hoping, oh, it goes up, it goes up. So my heart was going up and down all the time too. So it was less control. So even as a passive investor, I felt like I have more control. I'm in charge for my money because I choose who to invest with. And then the operator that I'm trying to invest with, they can give me all the updates, even 10 feet away. Me not doing it myself, but they're giving me everything, like the full experience of the investment, like how it's going, where we are, what we're going to do next. So that was more important for me. That's the reason I chose the private placements, like more personalized service.
Yeah, and generally because you're investing in like essentially one syndication, the returns are typically much higher than a REIT, which is kind of a normalized average across all the investments in the portfolio.
That's true. And because their overhead cost is much more to REITs when they form that. It's like there's a totally different structure. So I don't know. I personally like syndication structure much better because I had my own reasons. But there's no good and bad. Whatever works. The only thing I'd say the bottom line is everybody should invest, no matter where or what kind of investments or asset class they like. The bottom line is putting your money to work. That's the best thing that you can do to yourself. Don't trade your time for money. And that's what I learned from my experience. So my real life success story is, like I told you, I started as a passive investor. There's a few testimonials I added from my investors. Like I just got one-liners from there. So very quickly, I became active investor because my job was moved and I was looking to do something bigger and better to support my nonprofit. And I quickly got a chance to become co-GP or part of the general partnership team. So I started investing. So this is one of my investments early on that we started in 2020, 2019 when I became active investor. And within 11 months, we sold this property. It was 104 units we bought in Georgia, Augusta, Georgia. And our business plan was so solid. 6 months, we executed the plan. We only renovated 20 units out of 104 units. And within 6 months, our property doubled. So the experience was like this. Oh my God, you were like on cloud nine, like these kind of things happen, one of the unicorn deals. And then we, as a team, we decided we're going to sell it. So we packaged the deal. By month 11, we were completely out. It was crazy returns for our investors, like 120% returns. And on top of that, similar amount of losses into position. So basically taxes they kind of write off against all that. It kind of zeroed out everything on that. So that was a really good deal. And around the same time, another deal happened was there's 140 units, I think this one. This was in South Carolina. And this deal, again, was a really good deal. We renovated 60 unit, exterior and then interior was a very good looking property from day one anyways. And we sold in 18 months. 18 months, like super crazy. And our annual average return was 40%. And one of my investors, he was investing in both deals. He got super mad at me. He's like, what the heck? You told me these deals are 3 to 5 years. You're exiting in less than 2 years. I'm like,
Yes.
oh, is that a problem?
Yeah.
Because
I want him to say that in today's environment, right?
I'm like, what's that? He's like, no, because it's too much cash. Because it's like it's a lot more tax liability for me. I'm like, you don't have to pay taxes in the first one because you have the deposition dollars and here as well. Because I think he couldn't relate to it that how much return he's getting back. He never thought about that. And we're just thinking, okay, I'm just investing for 5 years. After that, I'll see everything. But he got to see that, in first instance, within 18 months, the two big returns. So it was just like really surprising for him. I think basically that was the reason. But it was funny the way he asked me, like, oh, you told me 5 years, why would you exit so early? So So, next slide I'm going to talk about is we learned about how to make money. You can invest passively, you can invest actively, and whatever resonates with you. So, the next one was important for me, protecting your investments, because that's the number one thing. You can invest, you can make money, but learning how to create the protection around is as important. And a lot of times, people think that it is okay to make money, and they kind of overlook, it's kind of oversight on the potential risk, before even investing or after you're investing. So one thing I have learned from my experience is that there's no way you can completely eliminate the risk, but you can learn to manage the risk. You cannot eliminate, but you can manage. But if you have a game plan, how you manage the risk before investing and after you exit, that's the best thing that you can do yourself. And again, everybody has a different scenario, everybody has a different storyline. And then you have to create, depending upon your appetite, what needs to be done and how you want it to protect it. And you have to create the strategies, like to create that safety net for yourself, that you're multiplying money all the time. Like for me, it's just like I believe in reinvesting. That's what my strategy is. I do not take much money out, take some money out from my nonprofit, and I take rest and I find another safer investment. And I just invest. I just reevaluate everything. I look at each and deal very closely. That's the due diligence I think I'm going to go through in the next slide. Because that's very important for me to dig deep and understand, how they're coming up to this market or this number, because every number, every market, every project has its own story. So it's very important to understand that story and then see how that align with yours. So due diligence, I'm going to give you the definition over here, is a thorough evaluation of investment or anything, whatever you're trying to do. You got to understand the liabilities, the overall potential, what you're going to get out of it. Does it align with your vision? And that's the true definition of due diligence. And the objective here is to find the safer investment, and you assess everything ahead of time, and you're going to get to the results, whatever you're looking for. And for that, what I did was, which is crucial for me, the risk mitigation that I was talking earlier. Like I say, you cannot eliminate, but you can always mitigate some of the risk. And then that helps you, because once you're not worried, it creates, again, some space in your mind where gives you ability to stay in the present moment and make the right decisions for yourself, or informed decisions, because you're grasping on things much quicker because there's less chaos in your mind. And if you're just worrying about, oh, I shouldn't do that, I shouldn't do that kind of thing, you're kind of limiting yourself. So you have to go beyond a little bit that. And my due diligence steps were risk mitigation, making the right decision, and look at the valuation accuracy for every deal. That means, asking the operator not just the pitch deck, but also the underwriting. And these days, if you do not know how to underwrite the deal, use ChatGPT, because there's so many AIs available out there. They can translate things for you. They can translate the numbers for you. They can tell you the story behind the numbers, like why somebody do that, and write down those questions, ask those questions. Legal compliance is another important one for me, and I think should be for everybody, to make sure that everything is in line legally, whatever you're trying to do, and identify any red flags. If you have question about anything about the investment, I ask usually. I do not hesitate. And I think everybody should do that, because you got to know the whole story in order to do any kind of investing or putting your money anywhere. So these are some of the pitfalls that I've learned from my experience. A lot of people, they just neglect the due diligence because they think like it's a chore, they just go by, the gimmick or the shiny objects, or somebody's talking so sweet, or the smooth talker, or somebody appearance looks good, or somebody's name is big. Like, okay, what could go wrong? Let me go ahead and do that. So this is, to me, is just ignoring all the red flags that comes along with that, and also, neglecting the main thing that you need to do. And the other thing is people lack diversification because if they choose one asset class, they just go with that. And we have seen that lately, people who are heavily invested in multifamily, they might be riding on some deals. So diversification is important, whether it's in multiple real estate asset class or you're doing stock market or digital or whatever you're doing. So diversify, do not put all your eggs in one basket. And the returns, I already talked about that, overestimating returns. A lot of time people tell their story, in the spreadsheets, and then numbers could be like really flashy, but don't go by that. Just try to dig deep and learn what's behind those numbers. Communication is a really big one. I heard that from a lot of people that once sometimes you invest and people go silent on you, they do not respond to you, or they do not answer your phone calls, your emails. So that's kind of very very scary for a lot of people. So these kind of things you should not overlook. You should just talk about that upfront, and that's what I did. Because if I wanted to invest in somebody, I wanted to go on to their list, their CRM system. I tell them, okay, put me into your investor list and give me your updates for the next 3 months, 6 months before forming a relationship with anybody, because I wanted to learn their communication style and then see how many times they can answer my call, and purposely ask the stupid question and see, it might be stupid for them because sometimes, and in my dictionary, I should say that no question is stupid question. If you do not know the answer, that's the right question for you, right? But you might want to ask simple questions too sometimes to see what their appetite is. Are they answering? Are they getting irritated? That will show you their personality, how patient they are. That's how they're going to treat your investment. So that's the reason it's very important to do your due diligence. Go ahead.
You mentioned red flags. What are some of the red flags that passive investors should look for?
So number one is you look at the pitch deck, right? So I said their numbers could be very flashy numbers, could be 20% IRR, could be 25%, could be alarming, that you can see, can you do that really? If somebody saying 50% IRR, or I can give you your money back next year, it's going to double the money. So these are totally red flags. These could be the Ponzi scheme, because if somebody's telling you, I'm going to give you 15 to 70% return, very conservatively, and over the course of 3 to 5 years, you look from 1.5 to 1.8% return on your investment or multiple, that makes total sense because that's doable. So you have to understand what is doable, what is not possible. So that's the reason I'm saying pay attention to the number. Every number tells you a story. Learn to kind of read in between the lines. Not
Yep.
just like, okay, somebody's offering me 25% return. Oh God, this is the best investment versus this. But dig deep to figure out why is 25%. Because if it's a higher return, that's a red flag right there for me.
I think it would be really dependent on the asset class as well. And certain asset classes, the red flags are that they might invest in short-term debt or variable debts instead of fixed debts, right, for multifamily. And then the other thing that I've always found to be important is capital calls. So that's a investor has multiple capital calls or capital calls in the past that they haven't allocated sufficient funds for their investments is oftentimes a red flag. What are your thoughts on that?
Yeah, that's really a good thing that you brought it up, capital call. I totally forgot to add that. I should add that in my slide too. Because that's the number one question you wanted to ask. I mean,
Yeah,
for the any
and what,
capital calls in the past, because that shows you how they've been managing their investments.
Vinki, could you explain to investors what a capital call is? For those that who don't know.
I'm sorry, say that again.
Yes. Could you explain to investors what a capital call is? Because we have some investors who may not be knowledgeable about what the capital call is.
So capital call is two ways. One is the capital call when you launch your deal, when that investment is launched and then it's been announced, and then you send out a form, okay, say you soft commit. So people soft commit. And then you say, okay, I'm going to call the capital on certain date. That's a good capital call because you're investing the capital after your proper due diligence. You feel comfortable investing in that. That's a good capital call. But then there's another form of capital call. That capital call is it's a property down the lane, 2 years, 3 years, 5 years, they kind of belly up. Could be any reason, could be bad property management, could be bad asset management, could be bad operator, all these things play a role in that. So if that kind of incident happens, so you belly up, there's no money in reserves, or they did not calculate purposely, ahead of time, or they did not pay attention when they're putting a business plan together, that they need to have ample reserve if something goes wrong. Because the best thing to look at into any deal is not what the good things are, because the operator is going to do a good job, or syndicator is going to do a good job to tell you what is good about the deal. Your job as an investor to invest or do your due diligence is find what could go wrong in this deal. That's the number one thing. So if something goes wrong, what happens is now operators or syndication, they struggle for capital. If they don't have deeper pockets, they're going to go out and they're going to ask the investors, okay, we are doing a capital call, you pay this much money more. So a lot of people, they don't want to do that, but that's not good. So you wanted to ask the operator, whosoever you wanted to invest with, did you have any capital calls or any of your investments in the past? So that will tell you their track record, then you can go from there. Any more questions?
No, I think we're good.
Okay. So the next slide is building generational wealth. Like I talk about all the time that, real estate investing is not about money making. It's seriously not. It's about generating wealth. It's creating a legacy. Because I have heard this multiple times that, you don't wait to buy the real estate. You buy real estate and wait. Because I know so many people who invest in real estate for long term, like forever. They buy real estate and they never sell. And when I say my timeline is 3 to 5 years, like, why are in this kind of real estate? Why can't you just buy and forget it? Just, it's there forever. So like, again, what aligns with you. So that's like basically your own story. That's something everybody has a different perspective. So you, excuse me, you play your own story, what aligns with you. Accordingly, you pick the investment. So that maybe the rich people or the older people, they just wanted to invest long term. They don't want to deal with the things that, okay, I exit, I reinvest, I exit, I reinvest. They just wanted to buy one time and they just sit on that forever. And they just, again, they just give that to their heirs in the past. So they have the trust and all those things. We'll talk about that in the next slide. So that's how they're creating their family legacy, basically, because they're creating a lasting wealth, which is growing over time. And they do the long-term holdings. But you can do the same thing with 3 to 5 years. You can diversify, you can reinvest over and over again, and you can create wealth that way. Like I say, it's a wealth building strategy. It's not just like quick money making. If somebody's selling you quick money making, I would say run away, because it's not a Ponzi scheme, seriously.
Yeah. The question I have on this slide, as you talk about long-term holdings, we know that a lot of syndications are 3 to 5 to 6 year holds, where at the end of the fourth, fifth, sixth year, the asset is liquidated, is sold off, and then you realize the capital appreciation and the profit for the individual passive investor. And then that investor has to reallocate those funds, have to invest in the next passive investments, the next syndication. Could you talk about how they build up that generational wealth, given that there is the need to have a long-term hold? And from a passive investor perspective and building that generational wealth, how should they think about positioning the investments for long-term growth and long-term hold?
Yeah, that's a very good question, actually, because that's the biggest benefit in real estate, the depreciation, the tax money that you get back. And I'm going to share with you the couple investments that I have is in the affordable housing that we're doing. I just closed earlier this year, and that happened to be in the opportunity zone. So opportunity zone is a really good investment. This was something that Trump started in 2018. And it's kind of at the tail end. It's going to expire in 2028. But the investors who came on board with us on this affordable housing investment in opportunity zone, they get the tax deferment until 2028. But who knows? Trump is changing a lot of things. Who knows? He might bring it back. So if it brings it back, like initially it was for 10 years. So basically you just kicking the can, not paying any taxes for 10 years. And after 10 years, it's tax-free money. Everything is tax-free because you're investing in opportunity zone over and over again. You're reinvesting whatever you're getting. So that's what our investors going to get until 2028, because if they have any kind of capital gain, even in stock market, and if they deploy that in opportunity zone, they will be able to kick the can until 2028. They're not liable for any taxes. For a couple more years, they can make money on their earnings, on their long-term gain. So, and the other thing is, we are really high about taxes. And the other, like the current deal that I'm working on, I'm launching today or tomorrow, sometime soon. It comes with active tax credits. That's like dollar for dollar. And you can use those credits against your ordinary income. It's your W-2 income, but you can use against those. So we get that too. So beside that, there's a depreciation. That's what you're talking about. What happened is, let's say, for example, if it's a value-add property, you go in, you purchase the property, and then you do cost aggregation. And cost aggregation, just to simplify that, means you just take the whole building minus the land, and you just create the cost. You kind of segregate, assign dollar value to each and everything, like for the carpeting, for the ceiling, for the fixtures, whatever, it's 3 to 5 years, whatever it's going to be. Accordingly, you just get the depreciation based off of that. And sometimes, like one of my first deals, like I told you, we got 120% in the depreciation because we use the leverage in that too, right? Because let's say the leverage is a loan that you're getting. Because let's say if you're buying a $10 million property, and if you're doing the 70% leverage, you're getting 70% loan, the $7 million, and then $3 million that you're raising. But when you're doing a cost segregation, you're doing it on the whole amount of the property value, not just whatever you invested cash in there. So that gives you the bigger depreciation dollars that you can write off, and then we give it to investors that they can use for their write-offs. Does that answer your question?
Yeah, it does. Yes.
So the next one is when you're building generational wealth. So some tips over here, you might want to create the LLCs, trust, or estate. It's very important. We always overlook. We think that, oh, why should we create a trust? It's a living trust. It's not like that. I used to think that too. Why do I need trust? I'm going to die. I'm not going to die. But no, you need that because you don't want your heirs to go through this probate and all the other things. It's kind of easy, kind of inheritance or the transition of wealth, basically. So, but I'm not a financial advisor or wealth advisor. So you might want to check with your financial advisor what works for you, what aligns for you, whether it's a trust or a state or LLC, how you want it to protect your wealth or how you want it to transfer. So you might want to dig deep into that and do that for the wealth generation. And my outlook, before I go there, any questions for me before I share my outlook for 2025?
Hi, thank you for that. So quick follow-up with regard to this. We're thinking about strategies for our investors on making their portfolio tax efficient. So you talked about depreciation, right? But are there other type of strategies? One strategy that we're thinking about deploying, and I've deployed it specifically, is using self-directed IRA to invest retirement funds into real estate, into crypto, into any other type of non-traditional investments. Any other strategies that come to mind that help to reduce taxes?
Yeah. This is a really good strategy that you told me about leveraging your 401k. And you cannot invest from your 401k. You have to move into SDRA, or you can create a EQRP. That's another way, is enhanced retirement plan. And believe me or not, the tax code is written so differently for both of them because if you take the EQRP route, there's no UBIT tax. So
Yeah,
UBIT
that's
is
right.
unrealized tax, because what happened is when we're buying these multi-million-dollar properties, we leverage, right?
Yep.
So leverage is kind of, it falls under the UBIT tax. So when you have a SDRA, you might realize that. That's the reason you wanted to get the depreciation. And you have to work with your CPA. Don't quote me on that, but you have to work with your CPA if there's any tax dollars, because then the depreciation that you're getting, you should be able to write that off against your retirement too. because
Yeah.
they say, okay, there's no taxes in retirements, but there might be some, you know, because the leverage is always there. And UBIT is going to play a role in the STRA, but not in the EQRP because the EQRP code is written differently. But that's a really good strategy. If you don't want it to use your ordinary income, it's always a good idea to leverage your 401k through SDRA or EQRP to multiply the wealth until you retire. Because in 401k, how much you're getting? Just like I was collecting a dust,
Yeah.
basically 4%, even
Yeah.
6% maybe. If my company was matching it up, still you're getting not very good return, basically. So you can do much, much better if you're investing in real estate. It's a safer investment compared to stock market. It's less volatile. And I think in the stock market, too, if you do the comparison, even though it's going to be apple versus oranges, if you take the rule of the thumb, you're just making around 7%. If you're like really, really good in stock market, average out is going to be that much. It's going to take 10 years to double your money, right? The rule of 7%. But if you take that and put it in real estate, again, safer investment, proper due diligence, right partners, if you check all the boxes, you might be able to do much better than that.
Yeah.
You might be able to quadruple that. Who knows? It's all, that's what I'm saying. It all depends upon your strategy, your vision, your story. So
Yeah.
this is like picking up the pen and writing your own story. Not just like he's doing that or she's doing that, I have to do the same thing. Seriously, it's not 100% a cookie cutter. Yes,
Yeah.
you wanted to learn from others. You wanted to learn from others' experience for sure. And that's the smartest thing to do. Learn from others' experience and create your own story.
I like that with commercial real estate and residential to some extent as well, but it's much more transparent. You can you can write your own due diligence rather than rely on analysts, which is like throwing darts at a dartboard to some extent, right?
That's true. It's gonna always hit or miss. I remember my stock market days because I inherited that. Basically, my brother-in-law, he was a stock market gig. He used to teach stock market. He was a chairperson for San Jose State University. He used to chair the engineering department. He was a professor for multiple years. And but he was stock market gig. He was the one who launched this artificial or AI project like 30 years ago.
Hmm.
And he invested like 10 million or 20 million. And there was like 4 or 5 partners. Everybody invested like 10, $20 million in this. And then they went belly up. He lost all the money in that because the projections were not done right. Or I think I would say the climate, or we were not ready for AI at that
Yes,
time. That was
exactly.
very
Yeah.
early stage at that time. So it didn't fly for him. But he was a stock market gig. He made tons of money in there and he used to teach stock market. So that's how my husband learned. He kind of inherited that. And from him, I got it. I started doing that. I was big in stock market, but I remember I used to work for a financial institution, and I think early 2000, sometime around that time, since I was the back end of the trading floor, I was the IT though, but still we were supporting the back end of the trading floor. They told us, okay, we cannot do our own personal brokerage anymore, so we had to close all the accounts or freeze all the accounts. So I moved away from stock market at that time. So I think that's the time it happened that we built our new home. I learned about real estate investing. So that's why I think everything is aligned. Because remember how Steve Jobs used to say that you cannot connect the dots in the future. But when you look back, you're able to connect all the dots, like why something was happening, and learn from the experience. And accordingly, you can create your future better a little bit. So, any more questions?
No, let's hear your outlook.
Yeah, my outlook is
Exciting.
like, so I don't like really, I don't know. I'm a very positive person. So like I always say that, where others see fear, I see a window of opportunity because, my philosophy is whenever there is a challenge, there is a solution. And also there's an opportunity. So for my outlook for 2025 is I'm just going to think like Warren Buffett. When others are fearful, get greedy. So this is the time to get greedy because if you have the bandwidth and if you have the appetite but proper due diligence, I'm going to stress on that. Can't stress on that enough, proper due diligence and know exactly what you're doing, have the clarity 100% what you're doing. Then you want to take the risk, and according to your risk appetite and stick to the fundamentals. That's the number one thing. right market, right operators, job growth, population growth, emerging market or not emerging market, where you're buying. All these things are really important. What is the demand? What is the supply? You know, so all these are the basic fundamentals. And sometimes we just overlook. We think, oh my God, this operator is doing so well. He has done like 100 deals. Maybe this deal is gonna fly too. No, each deal has its own story. So you want to dig deep in each and every deal to the nitty gritty details. And that's what my goal is. And leverage smart debt, we are focusing just on fixed debt only, so that less volatility, over the course of time. So a little bit peace of mind. I already mentioned choosing the right partners. And last but not the least, I wanted to say, like I mentioned earlier, there might be some deals that are hurting big time. Those are like from 2021 onwards, and we might get a lot of opportunities. So just I think hang in there, just like me. I'm just like looking for good opportunities, and I just feel like there's going to be a lot of opportunities for us this year, towards the end of the year, maybe.
I agree with your last point, looking for distress in the market, especially for those multifamily syndications that got into variable debts 2021 timeframe and onward. How do you look for those debt opportunities? Do you have a sourcing pipeline where you can get into and get a good deal?
That's a very good question, actually, because that's where the networking piece comes in. So
Mhm.
you have to set up your network, your nexus, talking to people, making connections, and then kind of staying on board on like who's doing what kind of thing. And real estate, over this real estate arena is not very big. It's a very small industry. Everybody knows everybody kind of thing. Everybody knows even what deal anybody is doing. So it's a very close knit. I mean, it's not that big. It looks like very big once you enter, and once you're there, it's just like you pretty much know what's happening. So it's just like all networking and making strong relationship with the brokers so they can bring you the deal. Even the operators, a lot of times I have seen, people who are trying to raise capital, they don't want it to talk to too many operators. They just wanted to stick with one or two or five, because the thing is, until unless you talk to more people, you won't know what's happening in their life or with their deals. So you never know who has the opportunity for you. So it's always a good idea to network and create, long lasting relationships, like dig deeper on your relationships to just go one step beyond, average people or the average relationships.
Yeah, the other question I have with that was that some pundits, financial pundits, are tossing around the R word, recession. And what asset classes would you classify as a bit more recession proof, recession resistant, rather than those that may not be as recession resistant and that you are investing in today?
Yeah, this is a very good question, though. Again, I'm gonna say it depends upon your vision, your focus. What your storyline is, what your appetite is, basically. And then what resonates with you. If you look at the asset classes, if you say multifamily, I said earlier, it's a recession resistance because everybody needs a house to live, place to live. So then if it up to the storage, they will say storage, self-storage is recession resistant because of the market going up, inflation rate, less jobs, more unemployment, all these things are gonna make people downsize. When they're downsizing, what they're gonna do with their stuff? Storage comes into play, right?
Right.
And then if I go to mobile home parks, they're gonna say, okay, apartments are nice, but it's like way too expensive. People cannot afford the apartments. Maybe they wanted to downsize. Maybe they wanted to go live in the mobile home parks.
Yeah.
And
Yeah.
it depends upon the area where you are, your vision, what you're looking for, what market you're in, where you are. All these things play a big role, like a deciding factor. And this is a very good place to tell you here that I'm hosting a virtual 2-day conference in June, June 6th and 7th. And the conference is Go Beyond Multifamily. So I'm bringing all the key speakers in the industry to that conference, from David Lindon all the way to Chick and Gino, and Joe Fellas is going to be there too. And then multiple speakers going to be there 2 days, and they're going to be sharing wealth of knowledge on all different asset classes beyond multifamily. because we talk about multifamily all the time, but we wanted to introduce our investors to other asset classes as well, so that they know, because like, for example, industrial returns might not be the same exactly as multifamily, but that could be a really solid asset class.
Mhm.
Because in industrial, I have like maybe 20 industrial investments, right? Stake in 20 of them. But the thing is, those are solid in a way because this back lease. So people who are the operators, they just wanted to leverage their cash, and what they're doing is they're selling the real estate portion and putting that money into their business to make that business scale, right? When they're scaling the business, it's more money. And the leases are just like really long, 10-year lease with 2 10-year options, like 30-year lease. So you're not on the chart like every year for the new lease. So a little bit less operational. And also, if it's an absolute triple net, you don't have to worry about anything. And then it's taking care of everything. So it's a strong asset class. So, but returns might not be exactly the same. But again, that it comes to, again, your story, your vision, your strategy, what aligns with you. So that's the reason I say diversification is the best thing. Because you take some risk, you cannot eliminate, but you can mitigate some. You can put it over here, some money, put it here, some money. Not all the eggs in one basket. It's diversified portfolio. You always, I would say most of the time, you're going to be on the positive side.
I would also say that it really depends on the asset class. So if you think about recession pushing down all the asset classes, those are in class A will move down to class B move down to class C, and so on and so forth. You'll see that recessions typically do provide that movement in the industry.
Yeah, I think, again, it's your perspective, how you look at things. Everybody looks at things from a different set of glasses.
Yep.
From classes perspective, to some people, they just wanted to focus on class A only.
Right.
Class A, price
True.
ground up and all that. Some people, they say, okay, no, we can handle maybe class D. But for the other people, they might get totally no, because could be war zone, they
Right.
don't want to do
Right.
that. So that's what I'm saying. It's just like, it's your own
correct.
story. Once you understand that, you're better off. And it's like better decision making, basically.
Mm.
That's the way I look at it. And then on the next slide, I put it over here. This is my favorite slide, actually. The mindset matters. So you got to think like an investor, not a W-2 employee, not a corporate employee, because been there,
Right.
done that. Because investing is not about the quick wins, it's about consistent growth and patience. Like, I had an investor call before I came to your webinar. And this is my long-term friend from my previous job as well. So it's like, he was just like getting a little bit antsy about his investment. He's been invested for 2 years. But the thing is, timeline is 3 to 5 years. And the property is positive cash flowing, doing really well, but we don't want it to exit early, right? We want it to exit at the timeline. So that's what I was trying to tell him. Like, when you're investing in real estate, you got to have some patience, but you got to be consistent with your efforts. And that's when I'm going to bring you the success. Because it's not an overnight get rich scheme, like a lot of people talk about that, but it's not like that. And then I'm going to mention here some of the mindset traits, have a long-term vision, some discipline, and patience. I already mentioned. Patience is the key, because it's a marathon, it's not a sprint. And you might have heard a lot of people saying that.
Right.
And I think this is it. This is some of the action steps, I wrote for everybody, like define your goals, long-term goals, short-term goals, because sometimes you get overwhelmed with your short-term goals, but you do not realize how much can you do in long-term. So it's better to break it down into the smaller chunks and identify investment type. I can't stress enough, figure out your own strategy, like what resonates with you, not with somebody else. Don't let somebody else tell you what to do. Because when you give that power to somebody else, you're always going to be dependent, and you're going to be thinking or looking up to somebody. Now tell me what next. No.
Right.
So write your own story and then find the trusted partners and then execute and monitor, basically. That's it. Have a plan, execute, and just sit back, relax, Joe, enjoy your life. That's what I like to do. So my upcoming summit, go beyondmultifamily.com, June 6th and 7th. Please join us. And we are offering a special discount for the VIP members. So they will get the recordings, lifetime recordings, and also they'll get a book written by Kim Lisa Taylor, the attorney, How to Legally Raise Capital. So if you wanted to use this code, please go ahead and do that. You'll get 20% off on the VIP tickets. And I would love to connect with everybody. I wanted to quote over here something that Mahatma Gandhi said. You might everybody know Mahatma Gandhi. Your future depends upon what you do today. So focus on today, not the past, not the future. Stay in the present moment. And because your present moment is going to create the next moment. Your decision in this moment is going to create the next moment for you. So if you get that understanding, you're going to be making the right decisions all the time. And I would love to connect with anybody and everybody. You can connect with me on LinkedIn, or my contact information is right here.
One question we typically have for our guests is, if you go back 20 years, what would you tell a younger version of yourself?
I will tell myself to start early.
Yes.
I will tell myself not to trade my time for money. I will tell myself to learn how to make your money work for you. So all these things I didn't know at the time. And now the other thing I will tell myself, that not to do everything yourself, learn to delegate early on. Because I know it sounds like, oh my God, so many expenses. But the thing is, when you learn to delegate, that's the time you learn to scale.
When do you know to delegate? Like, when do you know to delegate and what to delegate?
Um, I think very early on, there's no time frame to delegate. As soon as you can, delegate all that repetitive tasks that takes up your time, all the non-value add tasks. So delegate that. Don't do it yourself. Give it to somebody else. Like, for example, your lead magnets, your website. These days you can build anything with AI, and being for the IT folks, it's just being like, oh my God, it's just like one day of work. But one day is this like 24 hours. It's a lot of time. So hire somebody for $500 to do it for you. So free up that time, because you do not know how many ideas that you can create in that time, and that you can implement and grow and scale much bigger.
The other question we always ask is, how do you give back to your community? And I know you have your nonprofit, and you can talk a little bit about that as well.
That's very important to me. And like I said, that's my reason of being, or that's my mission, to give back. And my goal in this life is to connect with others and help each other grow. I think that's the purpose of life, is for everybody. It should be for everybody. But I think in the chaos called life, when we come here, we get entangled, we forget our true purpose. But I'm very aligned with my purpose. And then I help the people who come around, or in my circle, in my network, through education, through financial freedom, teach them, or through my nonprofit. Like, I have a nonprofit that geared towards women and children. That's privately held nonprofit. We do not take any money from anybody. But our investors, by default, they're helping our cause, because they're investing with us, and the profit share that we get, not investors, we give 100% back to them, whatever we promise them. But whatever our share is, percentage of that share goes to my nonprofit efforts, so that we can support multiple charities, multiple students, kids, moms. Because that way, my goal is to create that mental space, in that chaos. So they are less worrying about the food on the table for the next meal, versus they're thinking something else more creative. That's the goal is right here. And my goal is, I'm going to emphasize that, to touch 1 million lives before I exit in a meaningful way.
Thank you, Vinki, for all the great information you imparted to today. Lots of great nuggets of information that we'll have to listen to again and pull out of this podcast and this webinar. If you want to reach out to Vinki, you can show your screen again. And to find out more information, please do reach out to her. She does have a conference that's coming up. Please enroll in that conference. And of course, if you want to find out more information about our content, don't forget to like and subscribe to our podcast on whichever platform you're listening to, and do rate us. We do read the comments, and so that we can make sure that we can continue bringing you the best educational content ever. Thanks, everyone. Until next time, keep learning to invest for generational wealth. Take care.
Thank you so much, John. I really appreciate that. Thank you.